I have the pleasure of speaking with you this morning about the One Big Beautiful Bill Act. This presentation will cover what you need to know for estate gift and income tax planning. I'm going to do my best to get through all of the slides, but it is a lot of material. On July 4th, 2025, President Trump signed the One Big Beautiful Bill Act into law. This was a significant tax overhaul and includes $4.5 trillion in net tax cuts. These net tax cuts were achieved by making several existing tax provisions permanent, repealing or modifying other federal tax provisions, and by introducing new federal tax provisions. A common trend that we're going to see this morning is the act making permanent some of the individual provisions from President Trump's 2017 Tax Cuts and Jobs Act that were set to expire at the end of the year. So the act did give us some changes to estate gift and GST tax laws. This slide shows all of the current exemptions and gift tax exclusions that Casey just went through. Now, how did the act change these provisions? The biggest change is that the estate and gift tax lifetime exemption will not revert to the approximate $7 million per person that it was supposed to be in 2026 as planned in the TCJA. So effective January 1st, 2026, the unified estate gift and GST basic exclusion amount is increasing to $15 million per person or $30 million per married couple, and that is going to be indexed for inflation every year. This will be reflected as a new basic exclusion amount in Code Section 2010 C3A, where it's officially going to replace the old $5 million exemption. This increase is considered permanent because there's no automatic sunset or an expiration date. So that increased basic exclusion amount is not going to be decreased unless we see a future Congress or president enact and sign legislation that's going to change that exclusion amount. And finally, the annual exclusion for gifts is going to remain at $19,000 per donee, and that annual exclusion for gifts to a non-citizen spouse is increasing to $194,000 for 2026. The act didn't include a complete overhaul of these estate gift and GST tax rules, so this slide shows some rules that remained unchanged, but I did want to highlight a couple because there were topics of conversation in the prior administration with conversations of tax overhaul. So the first one is that the step-up in basis at death is remaining unchanged. So this means that heirs will continue to receive assets with a basis equal to the fair market value on the date of the decedent's death, and that gifts made during life are going to continue to carry over the donor's basis. And the second one is that the act does not impose any new taxes on trusts or alter their tax treatment. So our common estate planning structures like grantor trusts, slats, grats, that's going to remain unaffected by the act. So what does that mean for estate planning? For those individuals who have already used up most or all of their lifetime exemption amount by making taxable gifts, this increase to $15 million in 2026 is going to mean that these individuals have more unused exclusion to use in 2026 and then in future years. For unmarried individuals with a net worth less than $15 million, and for married individuals with a net worth of less than $30 million, the likelihood of owing federal estate tax after death has decreased significantly with this. However, any of these individuals who do reside in one of the 18 states that impose an estate or inheritance tax, like Connecticut, New York, Massachusetts, they're still going to need to consider planning for minimizing state estate tax, even if they're under these federal exemption amounts. And most importantly, the Act's prevention of a decrease in the basic exclusion amount and this permanent increase to $15 million, it's going to give high net worth individuals and married couples time to plan carefully and consider strategies to minimize federal estate tax after death, now that there's no longer this looming deadline of December 31st, 2025 to use the higher exemption or lose it. However, high net worth individuals should not assume that they have unlimited time to plan. Instead, take advantage of the next few years to implement smart taxable gift planning and estate tax reduction strategies before a potential future change in Congress occurs, which might result in legislation impacting these provisions. Moving on to some income tax provisions, the tax rates and brackets that were implemented under the TCJA were made permanent under the Act. So this means that the current estate tax rates that are stated on the slide will remain the same. And had the Act not made these rates permanent, we would have seen many tax rates increase, and almost all taxpayers would have seen an increase in their taxes. But as we know, tax rates are only one part of the equation. Each tax rate has a set amount of income that falls into it, known as a bracket. And the more income that falls into a lower tax bracket, the lower your overall taxes will be. So for 2025, the tax brackets are not changing, but for 2026, the Act did give the 10%, 12%, and 22% tax brackets an additional inflation adjustment. So this will boost the amount of money taxed at those lower rates, which means in practical terms that all taxpayers will see slightly lower taxes no matter their income level. The TCJA had also nearly doubled the standard deduction, and this offered tax relief to many taxpayers and made the standard deduction more appealing than itemizing deductions for many people. The Act makes the standard deduction under the TCJA permanent with a slight increase. So what we see here is the Act building on what the TCJA did by slightly increasing that standard deduction for 2025 and making it the baseline for future inflation adjustments. So for 2025, the standard deduction is going to rise by $750, making it $15,750 for single filers and $31,500 for joint filers. The standard deduction will be indexed for inflation going forward. The Act also permanently eliminates personal exemptions, which was initially done in the TCJA, except that now seniors who are age 65 and older are going to be temporarily allowed a $6,000 deduction or $12,000 for joint filers for years 2025 through 2028. This additional deduction is subject to a gradual phase-out for seniors with a modified adjusted gross income in excess of $75,000 or $150,000 for joint filers. So for single filers, that's going to be completely phased out at $175,000, and for joint filers, it will be completely phased out by $250,000. This deduction is available whether you take the standard deduction or whether you itemize. And again, it's only temporary, so barring congressional action, that's set to expire after 2028. Moving on to some itemized deductions now. Before the TCJA, taxpayers could potentially deduct 100% of the value of their state and local income tax, known as the SALT deduction. This made itemizing more appealing for more taxpayers, although it did primarily benefit higher earners from a handful of higher tax states. The TCJA introduced an upper limit to the deduction known as the SALT deduction cap. And since 2018, the taxpayers have only been able to deduct $10,000 in combined state and local taxes. This was set to expire at the end of 2025. The Act is keeping the SALT deduction cap, but raising it to $40,000 in 2025. However, the Act is also directly limiting the SALT deduction for higher earners. So the increased deduction is phasing out for income between $500,000 and $600,000 for joint filers in 2025, at which time that SALT deduction cap is dropping back down to $10,000. So the way this works is that the SALT deduction cap is cut by 30% of the amount by which one's income exceeds a certain threshold. For example, take a taxpayer with $550,000 of taxable income. They're going to see their maximum SALT deduction of $40,000 shrink by $15,000, which is calculated by taking that $50,000 over the $500 and multiplying it by 30%. So with that calculation, you'll see the SALT deduction phase out to that old maximum of $10,000 at a modified adjusted gross income of $600,000. The $40,000 cap and phase-out thresholds are going to increase by 1% per year. The increased cap is effective only for 2025 through 2029, and after that, the $10,000 cap will be back in 2030. And finally, the widely used pass-through entity tax workaround is going to remain fully preserved under the Act. And that was not the case in previous House and Senate bills, which may have limited that. Another homeowner-related tax change in the Act is the mortgage interest deduction. If you're paying for a home loan, you may know that the interest you pay on your loans is generally tax deductible. However, there is a cap to the amount of interest that you can deduct. The TCJA limited the mortgage interest deduction to the first $750,000 in principal value, which was down from $1 million pre-TCJA for loans taken out after December 15th, 2017. The limitation was set to expire at the end of 2025, but the Act makes that $750,000 deduction limitation permanent. Also, starting in 2026, the Act permanently reinstates the ability of homeowners to deduct mortgage insurance premiums. While not on my slides, I also briefly want to mention that homeowners who made energy-efficient home improvements, such as adding solar panels or energy-efficient windows and doors, should take note that some of those credits are expiring at the end of 2025. So this is going to include the Energy Efficiency Home Improvement Credit and the Residential Clean Energy Credit. The law states that any purchases made after December 31st, 2025 will no longer qualify for those credits. One of the biggest changes in the Act relates to qualified small business stock, or QSBS. Under current law, Code Section 1202 allows U.S. individual taxpayers and other non-corporate taxpayers, such as U.S. trusts and estates, to exclude from U.S. federal income tax up to 100% of eligible capital gains, subject to certain caps, realized upon the sale of stock of USC corporations that qualify as a qualified small business. This was designed to encourage investment in small U.S. businesses. To qualify as a qualified small business, the taxpayer must generally have acquired the stock when the corporation originally issued it in exchange for money, other property, excluding stock, or as compensation for services, and the corporation must satisfy certain active business asset thresholds. Code Section 1202 currently provides for the exclusion of 100%, 75%, or 50% of capital gain, depending on when the stock was acquired, of the gain of sale on QSBS held for more than 5 years. There was no partial exclusion available for shorter holder periods than that 5 years. The capital gain exclusion is currently capped for each taxpayer, and that is called the per issuer gain exclusion cap. And this is capped at the greater of $10 million or 10 times the aggregate adjusted basis in QSBS sold during the year. Eligibility for the capital gain exclusion also depends on the issuing corporation's aggregate gross assets not exceeding $50 million before and immediately after stock issuance, and that amount was not indexed for inflation. The Act contains 3 significant taxpayer favorable improvements applicable for QSBS acquired after July 4th, 2025. This is an effort to further encourage investment in startup and early stage U.S. C corporations. And those 3 improvements are: number 1, a new tiered gain exclusion; number 2, an increased per issuer gain exclusion cap; and number 3, a higher gross asset threshold for qualified small business status. The existing rules that we just talked about will continue to apply to QSBS acquired on or before July 4th, 2025. Now, expanding on each of these changes, first, the tiered gain exclusion is now based on how long the stock has been held rather than when it was acquired. Also, there is a new partial gain exclusion allowed for a holding period of less than 5 years. So the Act is now going to allow a 50% capital gain exclusion for stock held at least 3 years, a 75% capital gain exclusion for stock held at least 4 years, and a 100% capital gain exclusion for stock held at least 5 years. Second, the per issuer gain exclusion cap is increased from $10 million to $15 million, and it will be annually indexed for inflation for years after 2026. So now that per issuer gain exclusion cap is going to be the greater of $15 million or 10 times the aggregate adjusted basis. The inflation adjustments do not retroactively increase the cap for gains realized in prior years. And finally, there is a higher gross asset threshold for qualified small business status. So the corporate level aggregate asset ceiling to qualify as a small business is increased from $50 million to $75 million, and it will be annually indexed for inflation for years after 2026. On this slide, I included a summary chart comparing prior law and the changes under the Act. for each of the elements of the QSBS exclusion. So what does all of this mean? These changes may offer enhanced flexibility in new planning opportunities and greater potential tax savings for founders of and investors in qualified small businesses that are structured as U.S. C corporations. The introduction of the new tiered gain exclusion after a holding period of 3 years instead of that holding period of at least 5 years is going to enable QSBS corporate issuers to plan for an earlier exit while still providing some tax benefit to their eligible QSBS investors. QSBS investors may still reinvest the taxable portion of their QSBS gain into a new QSBS within 60 days of the disposition without recognizing the gain under Code Section 1045, and that remains unchanged under the Act. Finally, the increases of the per issuer gain exclusion cap and the asset threshold for qualified small business status, it may attract more investments into qualifying businesses and may encourage certain pass-through businesses to be converted into C corporations to allow their founders and investors to access these QSBS benefits. Moving on to charitable giving. Taxpayers who take the standard deduction have not typically been able to deduct their charitable donations on their tax returns. However, beginning in 2026, for non-itemizers, the Act is creating a permanent above-the-line charitable deduction of up to $1,000 or $2,000 for joint filers for taxpayers taking that standard deduction. This will not be indexed for inflation. To qualify for this, contributions must be made directly to charity and not to a donor-advised fund or a private foundation. The Act also includes some changes for itemizers. So beginning in 2026, taxpayers who itemize deductions can only take charitable contributions to the extent those contributions exceed 0.5% of their adjusted gross income. Take, for example, a taxpayer with $200,000 of adjusted gross income and $10,000 of charitable giving. The first $1,000 of the taxpayer's charitable giving would not be deductible, and that's calculated by multiplying their $200,000 of income by 0.5%, but anything over that amount, which is the remaining $9,000, would be deductible. Second, the Act makes permanent the 60% adjusted gross income limitation on cash charitable contributions to public charities, and that was increased by the TCGA from 50%. Another change under the Act is that beginning in 2027, there will be a new tax credit of up to $1,700 for cash contributions to qualified scholarship granting organizations that provide elementary and secondary education scholarships. And briefly switching to corporate charitable contributions, corporations generally can deduct charitable contributions provided that the aggregate of such contributions does not exceed 10% of the corporation's taxable income for the year. In addition to that 10% limitation, the Act is introducing a new 1% floor so that corporations may only take charitable contribution deductions to the extent that those contributions exceed 1% of the corporation's taxable income for the year. The addition of the 1% floor is applying for years after December 31st, 2025. Due to these changes, charitably inclined individuals may wish to consider accelerating the timing of their charitable gifts to 2025, perhaps making a large donation to a donor-advised fund or a private foundation so that you can receive an immediate income tax charitable deduction that's not going to be subject to that 0.5% floor. Going forward, people may also consider bunching charitable gifts into a single year instead of spreading them out so that you can avoid multiple applications of that 0.5% floor. And then finally, qualifying individuals may also wish to consider utilizing an IRA qualified charitable distribution to make charitable contributions, since those distributions will also not be subject to the 0.5% floor on the charitable deduction, since that's not included in their taxable income. Continuing with the miscellaneous itemized deductions, the suspension of miscellaneous itemized deductions under the TCGA was made permanent under the Act. Prior to the TCGA, taxpayers who itemized could take deductions for investment expenses tax preparation fees, and unreimbursed employee expenses that exceeded 2% of their adjusted gross income. These deductions were set to return in 2026 until the Act made the suspension permanent. Note that unreimbursed educator expenses are the only miscellaneous itemized deduction that remain. Prior to 2018, certain individual taxpayers were subject to an overall limitation on itemized deductions known as the Pease limitation. A taxpayer subject to the Pease limitation was generally required to reduce itemized deductions by 3% of the amount by which the taxpayer's adjusted gross income exceeds the applicable income threshold. The TCJA temporarily suspended that limitation through 2025. Starting in 2026, the Act permanently repeals the Pease limitation and is introducing a new cap that will apply only to taxpayers in the 37% tax bracket. The Act will limit the benefit of itemized deductions to about 35% instead of the current 37% level for taxpayers in that 37% tax bracket. This provision effectively limits the value of deductions available to those in the highest tax bracket to just 35 cents for every dollar of itemized deductions. So take, for example, a married couple in the 37% tax bracket that claimed $100,000 of itemized deductions. They're going to see that tax benefit capped at $35,000 now instead of $37,000. The Act temporarily makes up to $25,000 of qualified tip income for individuals in certain professions deductible for years 2025 through 2028. It's a cap at $25,000 for both single and joint filers. The income is going to remain subject to payroll taxes and potentially state income taxes. Qualified tips are voluntary cash or charged tips received from customers or through tip sharing, and these qualified tips need to be received in occupations that are listed by the IRS as customarily and regularly receiving tips on or before December 31st, 2024. The Act also makes up to $12,500 or $25,000 for joint filers of qualified overtime income deductible for years 2025 through 2028. The overtime compensation deduction is available only for overtime pay required by the Fair Labor and Standards Act. Extra pay earned under state laws, collective bargaining agreements, or employers' compensation plans is not going to be eligible. And both of these deductions are available for both itemizing and non-itemizing taxpayers. Finally, both deductions gradually phase out for individuals with a modified adjusted gross income exceeding $150,000 or $300,000 for joint filers. Effective for 2025 through 2028, individuals may deduct interest paid on a loan used to purchase a qualified vehicle, provided that the vehicle is purchased for personal use and it meets other eligibility criteria. Lease payments are not going to qualify. Used cars are not going to qualify. This is a maximum annual deduction of $10,000. To be a qualified vehicle, it must be a new car, minivan, SUV, pickup truck, motorcycle with a gross vehicle weight rating of less than 14,000 pounds, and it needs to have undergone final assembly in the United States. To be qualified interest, the interest must be paid on a loan that is, number one, originated after December 31st, 2024. Number two, used to purchase a vehicle, the original use of which starts with the taxpayer. So again, used vehicles do not count. Number three, for a personal used vehicle, so not for business or commercial use. And number four, secured by a lien on the vehicle. This deduction also gradually phases out for individuals with a modified adjusted gross income exceeding $100,000 and $200,000 for joint filers. The last few slides that I want to discuss are here. So the TCJA doubled the child tax credit to $2,000, which would have expired at the end of 2025. The Act preserves this and increases it to $2,200 per child in 2025. That is a non-refundable child tax credit. Starting in 2026, the maximum amount will be indexed for inflation. Finally, that credit starts to phase out at a modified adjusted gross income of $200,000 for single filers and $400,000 for joint filers. Keeping on the topic of children, the Act establishes Trump investment accounts for U.S. citizen children, which are eligible to receive annual after-tax contributions of up to $5,000 per year, subject to annual inflation adjustment until that beneficiary reaches age 18. Additionally, children born in the United States between 2025 and 2028 will be automatically enrolled and will receive a one-time $1,000 baby bonus from the federal government for their account. You could almost think of a Trump account as a cross between a traditional IRA and a 529 savings account because, like an IRA, potential tax earnings are going to grow tax-free and withdrawals are generally taxed at the child's income tax rate. But like with a 529, the child doesn't need to have earned income to accept contributions, and nearly anyone can contribute to the account. Until the account holder turns 18, the Trump account assets must be invested in U.S. equity fund index or some similarly invested portfolio, and no distributions may be made from that account. In the year that the account holder turns 18, the account will convert to a traditional IRA, and the assets in the Trump account will continue to grow on a tax-deferred basis, and distributions will be income taxable in the same manner as a traditional IRA. Account beneficiaries can withdraw the funds once they turn 18. However, like with a traditional IRA, early withdrawals before 59 and a half may incur a 10% penalty unless used for specific purposes, such as the purchase of a first home or payment of qualified medical or educational expenses. 529 plan or an education savings account is a tax advantage way to save for a child or grandchild's college education. The Act enhances 529 plans by, number one, expanding the list of eligible education expenses to include books, tutoring, and fees for standardized tests. And number two, by increasing the annual distribution limit for K through 12 education expenses from $10,000 to $20,000. And by three, adding a new category of qualified expenses for older beneficiaries to include credentialing and licensing costs for those individuals seeking a career in the trades or pursuing licensing for professions such as the law or financial planning. These changes will be applicable to distributions made after July 4th, 2025. Finally, the Act made permanent the ability to roll over a 529 account to a Roth IRA as long as certain conditions are met. Thank you for your time. I hope you thought this was a helpful, high-level overview of the Act.